March 2025. A solar manufacturer in Germany quietly cancels 3 months of scheduled production. No announcement, no press release. Just silence, the kind that usually precedes something large shifting beneath the surface. A defense contractor in Virginia, operating in a country that once believed supply chains were indestructible, quietly adds physical silver to its strategic reserves. Not securities, not futures, actual metal. Meanwhile, 3 major Asian refineries stop accepting new contracts, citing operational adjustments, a phrase that has historically been code for scarcity. And in London, the world's oldest bullion dealer introduces purchase limits for the first time in its 340-year history, a span that survived world wars, depressions, empires rising and falling. They never rationed. Until now. This is not a warning about the future. This is the present. And if you don't understand what these signals mean, you're about to watch one of the largest industrial commodity crises of the 21st century unfold in real time. Across history, scarcity never announces itself with panic. It begins with small, almost invisible shifts. But these shifts rhyme with earlier crises. Oil in the 1,970 seconds, rare earths in 2010, semiconductors in 2021. They all started the same way, with a silent tightening followed by a sudden lock. In the next few minutes, we trace a pattern so old it's practically encoded into the economic system. A 3-phase lockdown that appears whenever a resource becomes strategically indispensable. Silent stockpiling, export restrictions, price controls, and rationing. The difference this time is unsettling. Oil had alternatives. Rare earths had substitutes. Semiconductors had capacity expansions. But silver, oddly undervalued for decades, has no replacement, no workaround. Not in technology, not in energy, not in defense. When silver locks down, entire industries pause. The media isn't talking about this yet, but phase 1 has already begun. Silent accumulation. This is the stage where governments and corporations accumulate supply quietly, efficiently, without signaling panic. Historically, the actors who move first always win, because the rest of the world only notices the shortage when the shelves are empty. Late 2023, China stopped reporting silver import statistics. A country that consumes nearly 20% of global supply simply went dark. In economic history, when a nation that large hides data, it is never about transparency. It is about accumulation, shielded from market visibility. China did the same during key phases of rare earth consolidation, and when the world woke up in 2010, Beijing controlled 97% of supply. India followed a different path. Silver imports hit 38-year highs in 2024, not for jewelry, but for strategic reserves. For the first time, precious metals were classified alongside national defense materials. Nations only do that when an industrial input becomes a strategic asset, a weapon of economic negotiation. Russia, early 2024. Every ounce of domestic silver production diverted directly into state reserves, not exported, not sold, withheld. Historically, countries preparing for financial divide or geopolitical tension tend to hoard gold. But hoarding silver signals something else, anticipated industrial scarcity. And then, the most astonishing part. The United States, a country that pioneered modern finance, shaped global trade networks, and once maintained some of the world's largest metal reserves, has no strategic silver reserve at all. Zero. Every ounce was sold between 2005 and 2015 under the assumption that global supply chains were infinite and paper markets could always fill the gap. While China, India, and Russia accumulated physical metal, America leaned on the illusion of unlimited liquidity, a bet on paper, and a dangerous one. Corporations, as always, were quicker to react. Tesla secured 7-year silver supply contracts in 2024 at fixed prices. First Solar locked in long-term agreements as well. Panasonic, LG, Samsung, they all bypassed spot markets entirely and went straight to mines. Historically, when manufacturers begin to lock in supply years ahead, they are reacting not to fear, but to data the public has not yet seen. This is how phase 1 always looks. Quiet accumulation by the informed, long before the public realizes anything is wrong. Phase 2 is already unfolding as well. Export restrictions and capital controls. This is when countries, often under the guise of national security, environmental protection, or industrial policy, begin restricting the flow of critical materials to reinforce domestic advantage. We've seen this pattern before. Indonesia banning tin exports in 2013 until prices stabilized. Prices doubled. The United States, Japan, and the EU scrambling during the 2010 rare earth crisis when China suddenly restricted exports under the pretext of environmental regulation, a strategic narrative masking a national industrial build-out. The psychological shift from open markets to controlled markets is irreversible. Once a nation realizes that restricting supply increases its leverage, the strategy spreads. Now, observe silver. Russia banned silver exports to sanctioning nations in 2022. Mexico, the world's largest silver producer, implemented export quotas in late 2024. Not a full ban which would trigger global panic, but quotas, enough to signal that supply should no longer be assumed. Peru tightened environmental regulations on silver mines, conveniently at the exact moment demand was accelerating due to solar expansion. Whether intentional preparation or coincidental timing, the effect is the same. Output slowed. Then the most alarming early indicator, 4 major South Korean banks halting physical silver sales in February 2025. Not because they wanted to, but because they could no longer source the metal. Banks, institutions with global access to liquidity and supply failing to acquire silver signals the point at which silent scarcity becomes structural. China went even further. It blocked citizens from purchasing precious metals through banks, raised risk classifications, and restricted online platforms. Historically, nations only move to prevent citizens from accumulating metal when the state itself is accumulating aggressively and wants no internal competition. Once export restrictions spread, markets fragment. The global system that assumed frictionless trade begins to splinter, and when fragmentation accelerates, the third phase becomes inevitable. Phase 3 is the most disruptive: price controls and rationing. This is the moment when markets stop behaving like markets. When authorities intervene not to stabilize prices, but to maintain order. History is littered with examples. In 1971, President Nixon closed the gold window. Foreign governments, especially France, were demanding gold in exchange for dollars. America did not have enough. Convertibility ended. Gold shot from $35 an ounce to $850 by 1980. That was not a price rise. It was a demonstration of what happens when a paper promise no longer matches physical reality. The silver market witnessed its own rupture in 1980 during the Hunt brothers' accumulation. As they demanded physical delivery of 200 million ounces, the major exchanges panicked and changed the rules mid-game. Trading was restricted, margin requirements exploded, and the Hunts were crushed. But here is what history forgets. Physical holders, regular people who owned silver in their possession, came out largely intact, even as paper markets collapsed around them. The same script repeated during the palladium shortage of 2001. Russia delayed shipments, inventories evaporated, futures contracts became impossible to honor. Exchanges forced cash settlement against traders' wishes. Those holding physical metal watched prices surge to $1,000 an ounce. Those holding paper watched the system fail them. Now, these historical shadows stretch directly into 2025 because the indicators for silver are already flashing red. Inventories on the major exchanges have collapsed from nearly 100 million ounces 20 years ago to under 40 million today. Industrial consumption burns through 1 billion ounces annually. All available stockpiles equal barely 3 weeks of global demand. And yet most people still believe the shelves will never empty. When the next major manufacturer steps forward and admits they cannot secure silver, not at any price, not through any supplier, the cascade will begin. Industrial buyers will panic first because their production lines depend on uninterrupted metal flow. Governments will move second, securing whatever strategic reserves remain, and the public will be last, arriving only when the headlines make the crisis official, by which point the doors will already be closed. In the paper markets, the problem is even more severe. For every ounce of actual metal, 100 ounces of paper contracts trade hands, a leverage ratio that has worked for decades only because almost no one ever demands delivery. But when inventories thin, when confidence cracks, when those holding contracts finally try to convert paper into metal, the system will not bend, it will snap. This is how Phase 3 expresses itself, with exchanges halting trading, with contracts being cash settled, with regulators stepping in to maintain orderly markets, a phrase that historically signals disorder behind the scenes. Picture what happens next. The major exchange suspends silver delivery altogether. The largest silver exchange-traded fund declares that physical inventory cannot be sourced and transitions to cash settlement. Your shares that once represented metal now represent dollars that buy far less silver than before. Governments impose emergency price controls, not to help citizens, but to slow public panic. Official prices stay low, while physical silver trades on the street at multiples of those numbers. Black markets re-emerge, not out of crime, but out of necessity. Industries receive first priority on allocation, aerospace, defense, solar, critical electronics. Retail buyers stand at the very end of the line. Dealers run out of inventory. Mints accumulate months-long backlogs. Premiums skyrocket. In previous commodity crises, premiums rose 20%, 40%, but in a true supply lock, they can detach entirely from spot price, rising 5 times or 10 times above the official number. In such moments, spot price becomes little more than a historical artifact, a memory of a functioning market. This is not fear. It is pattern recognition, the same pattern that has repeated across centuries of resource shocks. But silver is unique because this time, the world has engineered itself into dependency. Unlike the oil crisis of 1973, where new fields in the North Sea and Saudi expansion relieved pressure, there is no silver equivalent of OPEC waiting with spare supply. 70% of global silver output comes not from silver mines, but as a byproduct of copper, lead, and zinc. That means silver supply cannot easily increase. Miners cannot simply produce more silver the way countries pump more oil. They can only produce more base metals, something they avoid when prices for those metals are weak. New mines take 10 years to develop, sometimes more. The deficit is not a future scenario, it is current. Recycling will not save us either. The silver contained in electronics is too diffuse, too costly to extract. Even in aggressive recycling initiatives, recovery rates hover near 20%. The metal locked in solar panels remains unavailable for decades. And, in a bitter twist of irony, the very transition to green energy sold as the future of human progress is accelerating silver scarcity at a historic pace. Solar manufacturers have tried for a decade to engineer substitutes for silver paste. Copper oxidizes, aluminum lacks conductivity, experimental alloys fail under industrial scaling. No combination of metals has matched the efficiency, stability, and long-term reliability silver provides. On the periodic table, nothing else works. And because governments legally mandate renewable energy targets, demand for silver is not discretionary. Even if the price reaches $60, $150, or higher, solar installations must proceed. Factories must buy regardless of cost. A mandated buyer is the most dangerous force in any supply crisis because they cannot exit the market. The oil crisis had a solution. Rare earths had a solution. Semiconductor shortages eventually had a solution. Silver does not. This is the first major resource crisis of the modern era with no structural escape hatch, only price repricing. Violent repricing. What does this mean for you? Not panic clarity. The lockdown has already begun. Phase 1 is complete. Governments and corporations have accumulated. Phase 2 is active. Export restrictions are spreading. Supply lines are fragmenting. Phase 3 is approaching, the point where paper markets rupture and physical availability collapses. When Phase 3 arrives, the question will no longer be, how much does silver cost? But, can you find any at all? Dealers will sell out, banks will halt distribution, mints will have year-long delays, and individuals holding cash will discover that currency cannot be converted into the one asset retaining value. Because by the time the headlines appear, by the time the crowd realizes what has been obvious for months, the window will already be closed. The people who act early do not do so out of fear, but out of historical literacy. Physical silver in your possession, not in an exchange-traded vehicle, not in a certificate, not in the custody of an institution that can freeze withdrawals, but in your actual possession is the only position that survives Phase 3. Not because silver is mystical, but because it has no counterparty. No one can dilute it. No government can cash settle it. No exchange can rewrite the rules around it. This is not investment advice. This is observation of pattern. The same pattern visible during the gold decoupling in 1971, during the rare earth crisis in 2010, during the palladium panic in 2001, during the semiconductor shortage of 2021. Each time, the world assumed markets were stable. Each time, the world was wrong. I've shown you the 3 phases: silent accumulation, export fragmentation, price controls and rationing. I've shown you the historical echoes: oil, rare earths, palladium, gold. I've shown you why silver is categorically different this time. No substitution, no scalable new supply, no relief valve. The lockdown is underway. Nations are securing supply. Corporations are hoarding. And the average person walks through their day unaware that the metal powering the modern world is slipping into scarcity. Do not wait for confirmation. When confirmation arrives, it will arrive through panic, not through analysis. If you want proof, it is already public. Look at exchange inventory data. Look at export restrictions. Look at corporate supply contracts bypassing global spot markets. Every signal is there, for anyone willing to see it. This is the largest resource lockdown of the modern era, and almost no one is ready. Subscribe. Turn on notifications. Because the next phase, the one approaching quickly, will separate those who prepared from those who wish they had. The clock is ticking. The lockdown has begun. The question is not whether it will accelerate. The question is whether you will act before the window closes.